Hey, all right. It looks like we're live. All right, welcome to the broadcast. This is Trading Homework. I'm your host, Jon Tait. Today is February 3rd, 2021. This is a Wednesday. So we're getting ready for tomorrow. Tomorrow is Thursday. And one thing that is special about Thursdays is weekly options expiration on Friday. So I tweeted out ahead of time that day before expiration options strategies are like the 1-inch punch in the trading world. It's with the least amount of motion, we can have the biggest impact. So if you think about connecting with a pressure point, those kind of opportunities can be there. The highest percentage gains possible in a short amount of time are typically found in day before expiration kinds of tactics. So we're going to go over some of these tactics, and it may be a little bit more involved than what you're expecting. So first up, a disclaimer. Everybody's in a different financial position, and so I can't give you advice. I'm not a registered financial advisor. I just trade my own account. I'm sharing my research just because other traders might like to look at that, and that they may find it entertaining. So you'll watch me with winners and losers. So some people like to laugh at the losers, and some people like to cheer for the winners. So anyway, let's get going. What I've got on the screen right now is Interactive Brokers in paper trading mode. The market's closed right now. None of these are live prices or anything. And so this is not my account. It's a paper trading account. And I've got Tesla up. I've got some of the... I already built out in the options trader some of the combos that I want to look at for Tesla, just to illustrate the tactics. So the reason I'm looking at Tesla is because the options are fairly expensive. You could see the implied volatility is around 60%. So this is around near the historical implied volatility on it. So fairly high. And also it's a high price stock. And so people that may not think that they can do trading with Tesla if they have a small account, well, you're going to learn tonight that that's not true. You can there are interesting options trades you can do in Tesla even with small amounts of money. And so if you're a YOLO trader and you're putting your whole account into your trades, you may as well change the channel. This is not that kind of material. These are very low probability of success trades. And so the way that you can be successful with them is with quantity. So and also you have to be pretty selective. So just because we talk about something tonight, it doesn't mean that it's going to be a good opportunity tomorrow. You have to read it and take a read on the stock as it's moving tomorrow. And maybe in the beginning of the day, maybe closer to the end of the day, decide whether or not it's worth puting money into a trade. So that's what I'm doing. And these are the size of money I'm using on these kinds of trades. It's like lunch money. But as you'll see, some of the percentage returns that you can get from lunch money can turn into lots of money. I want to mention one of my favorite books. It's a fiction book, but it's also kind of a trading book. It's relevant to investing and trading, I think, quite a lot. It's called The Gambler by Fyodor Dostoevsky. I've got a really fun translation of that. I think it's a Russian book originally. And so I don't know what it's like to read it in Russian. It's not English literature or like a classic American novel or anything like that. And so maybe that's why I think it's so neat. It feels really exotic when you listen or when you read it. I mean, there's audiobooks too if you want to listen, but it feels really exotic. It's this kaleidoscope description of I think it's Monte Carlo. It's been some years since I've read the book, but the reason I'm talking about that book is if this kind of trading is interesting to you, what we're going to be talking about tonight, that's probably a fun book for you to read if you've never read it before. And it's also going to show you some of the pitfalls. A lot of the trades that we're looking at, according to the options calculator, have like a 1 in 300 chance of paying off, which would mean that you need to make 300 serial bets before you're going to get a hit if you're holding till expiration. A lot of these, that's what the calculator is based on. I mean, a lot of times what you're really playing is the overnight gap. You're betting that there's a big news cycle come out, unexpected news that wasn't priced in, and you hit a tail risk with a higher probability than how the market makers have priced it. The other thing that we're going to be doing is we're going to be building some options combos. And so these are not just straight up buying options. A lot of times by looking at combos, you're looking at things that maybe nobody else is really trading. Every combo you build can be fairly unique, and it may be that you're the only person with that combo. So that's another interesting thing about options trades. If you're not an options trader, don't tune out. You may learn a lot here tonight that might get you interested in dabbling a little bit or into reading some books about options. If you want to learn more, you want some reading material, I would recommend Options as a Strategic Investment. That book has been very helpful for me. I'm going to do a whole show on that book at some point. But for tonight, we're talking about research for tomorrow. There's a whole lot more trading I'll be doing tomorrow than just these plays. But I think this is a compelling piece of research that we can really easily make a whole show out of it. So let's start with Tesla here. And let me bring up the Tesla chart. One thing I always look at when I'm going to be doing some trading is, let me make this a little, well, I guess that's probably okay. There we go. Hopefully you could see this chart clearly. Let me make it a little bigger. So here's Tesla, and what I'm looking for is I'm looking down here at the bottom of the chart at this is the ATR. It's 14 period. I do have a stock charts package, but this is a feature you can get for free on stockcharts.com. You could put the 14 period ATR on there, and then whatever period you use is what this is going to be showing. So what this shows is that over the last 14 days, the true range, which includes gaps and it includes extremes and wicks and things like that, has been averaging around 38 points. And so let's round and call it 40. And that's a helpful thing for me. The other thing I like to do, so let's I'm going to open a side window here and just take a couple of notes about that. So we've got daily ATR is 40, and I better note down that this is Tesla. Let me put this in the window where you guys can see. We're just gonna mark a few levels here. Weekly ATR on Tesla. I can large size this too. The weekly ATR is 75. I mean, around this 75. So another reason I'm looking at Tesla is they're not having earnings right now. It looks like there's this nice flat base, and so to me, this looks like a 3 weeks tight kind of a pattern. If you're familiar with that, it's this nice flag. I mean, you can get some explosive runs higher from stuff like this, and so. Normally the way I would play it is very different, but because tomorrow's Thursday, if I think that a big move is possible and imminent, then you could get so much juice for on Friday. So a lot of times people are looking for how they could get more juice out of their for their money. And so an example is people are looking for stocks that are making huge percentage moves. Well, on this trading homework show, we're going to be looking at things that are that make thousands of percent sometimes, and not necessarily with a high probability. So the reason I brought up that Gambler book a few minutes ago is because one of the characters in the story bets on zero on a roulette wheel. They're all there. I guess staying at the hotel. These are kind of the socialites and things like that. It feels like it's that kind of scene. They all kind of know each other a little bit, and they're coming and going. People are making money and losing money and doubling down when they shouldn't and things like that. And in this story, somebody hits a zero, and then they put it all down on zero again. And those kind of wins are just crazy huge amount of money. It becomes like this legendary story. We see that going on with GameStop right now. There are people who had there's one guy, Deep Fucking Value on Reddit. He had 50,000 like a year ago or something, and now it's he briefly touched 50 million. So these kind of gains can become legendary stories and get people to do things that they wouldn't otherwise be doing to try to replicate that. We're going to be looking at things that have that potential, and they're all over the place. So it's if you look at how many people on Reddit tried to make that kind of money, I mean, there's probably just a handful. The odds are so low. But we're going to be talking about things that you chain a few of these together and they hit, and then you can turn a small amount of money into huge amounts of money. But again, low probability. All right. So the other levels we're going to look at. We're going to go over here. Let me move this chart out of the way now. And I'm just going to, I'm on the options chain for Tesla. And I'm looking, see, this is Wednesday night. It says there's 2 days until expiration. So tomorrow, during trading hours, it's going to be 1 day till expiration. And the longer you wait in the day to get started, the cheaper these options will tend to get that are out of the money. So what you can expect to see is you see these options here, like this one that's, let me clear these legs off. The further out we go, there's kind of an interesting phenomenon here. These options are all basically worthless. And as we get closer and closer to expiration, you're going to see a wave come over the options chain, pushing the worthless options higher and higher up this stack, closer and closer to at the money. So this $2 one, that's $900. If Tesla stays where it is in this range of around 850, in 2 days' time, if Tesla stays down there, this $900 option isn't going to be $2.03 ask anymore. It's probably going to be like 3 cents ask, sort of like this one down here is the 1150 one. And so the clock is really running on these things. This is not a good way to make consistent money, but it can be a nice way to juice returns if you don't mind shelling out some lunch money and you're spreading it around a little bit. So now we're going to talk about the other levels. So I'm going to come in here and I'm going to go to performance profile. And this tells me the price level of Tesla right here. It says underlying. It tells me the price level of Tesla at all of these different percentage changes. And so what I'm going to note down is the 10% level and the 20% level. Let's just start with the calls. So 10% level plus 10% is 940. Let's put the current price. Current is that's right here. This is where it closed, 851.70. So I'm just going to put 852 plus 20% is 1,026. All right. So I just clicked on a random one here. This is an 885 call. So let's take a minute and look at this. Or actually, yeah, it's fine. We'll look at this. So this is probably what, 3%, 3 or 4% out of the money, something like that. And it's got if you were, so right now, let's actually like flip it to tomorrow. So tomorrow we can expect that at the close, assuming there's no changes in implied volatility, it'll probably be $82 cheaper than this. So it'll probably be around $300 for this call. A 30% move is huge. But I mean, as you can see, you can make 22 grand, but you had to put up $300 to do it. That's if Tesla moves 30%. I think that's pretty unlikely. I think a move between 10 and 20% is really as good as you can expect. And so we're going to be looking at combos that are maybe a little more interesting for that. So if you were to buy this at the close for 300, it'll probably decay about half, maybe a third, be $150 or $200 of value if Tesla sits still on Friday at the open. Depending on commissions, that might be worth it to try and sell out of it. A lot of the strategies you're going to be looking at are just throwaway. You put it on, and if it doesn't hit, then you're out the money, because the commission that you would pay to try to get out of it would not be worth it wouldn't be worth it. But that's not the case with Tesla generally. The commission percentage, $2 is a percentage of 382 it's some fraction that's so small that IB is estimating it at 0% of the trade. And this percentage number can be a little misleading. Something else I want to point out here is the max return's infinity. If we zoom out, if Tesla makes a 100% move tomorrow, ridiculous. The option might be worth $82,000, somewhere in this ballpark, maybe even more because of the rise in implied volatility. It has a 15% chance, according to the calculator, as of right now, of being profitable. This is misleading because that assumes that you hold it till expiration, and also that you already bought it at the close today, which means you have the overnight gap tonight and tomorrow, all of tomorrow, the Thursday night gap, and then all of Friday. Well, we're just getting ready for tomorrow's session, so this number is going to be a lot lower by tomorrow, unless Tesla jumps up. But then that's misleading because we won't have locked in this price and had this profit probability. All right, so I'm not real crazy about this kind of a play. It takes a big move for Tesla to get here. I mean, it could do that, but let's say that it gets to 885, already a big move, but your option is almost worthless. So, like if I put it right here, and Tesla moves up 3%, that's 880. If Tesla rises 3%, guess what? You lost your $380. It had to go above 4%. It had to get to between 4 or 5% for you to even make money. So the break-even point's around 4%. I don't like that. 4% is a big up day. So I'm probably looking to be more stingy than that. So let's look at how we could do that. So one way is with a vertical spread. We were talking about that was $300, and the stock had to get to what did we say? A 4% rise. Let me get the calculator out. We'll figure out exactly where the. Oh, I'm sorry. It tells us the break even. It's right here, 888. The stock has to get to 888 for us to break even. Let's see how a way that maybe we can do better than that for the same amount of money. So we're looking to spend 300 on a vertical spread. And let's see if we can get a break even that's much closer to the current price. So if I buy this one, the 870, I can sell that other one was $3.85. Let's make another one that's around $3.85 right here like this. And so one thing to watch for is this column here is the option open interest. When I'm making a spread like this, if I think that I might want to sell it early or even trying to get into it, the reason I don't want to use this strike right here is because the open interest is so low. It's unlikely that someone else is trying to get in or out of this at the same time as me. It's probably like 3 or 4 times more likely at this strike that someone's trying to get in or out of it at the same time as me. So I'm much more likely to get better fills on these strikes that have high open interest. So this is something to watch for. Another thing is here, you'll see I have an average option volume column here. It's not showing for everything right now, but it does. I think it's showing for Tesla. And look at that. Tesla has over 800,000 option contracts averaging daily of volume. So what that means is it's pretty liquid. So I try and compete near the midpoint to get fills on something like this. So I may be patient with it instead of aggressively pushing my bid up towards the ask. Let's see here. So the price of this is less. Now let's go in. It's less than $3.85. And if you notice, we're actually selling the contract that we were originally looking at buying. So we come in here to the performance profile. You'll see the break even is now much better. It's 873, which is under 3% now. So we're starting to, if we hold till expiration, just like in the other example, the Tesla only needs to get to 873. So we've improved that situation. However, we've capped how much we can make, and really by a lot. The max profit is much lower. Our profit probability is much higher, 29%. What was it on the other one? Let me take a look. It's easy to do. I'm just right-clicking on the ask. Yeah, this is 15%. Another one was 29%. So we've improved our odds of winning on it by double. But again, there's a lot of assumptions baked into that number. So take that with a grain of salt. Everything you see in the simulator, it's just making guesses. And it is computing some math and things too. So the commission's a little higher. Minimum investment's the same. I'm not real crazy about this one. I think I had a simple bull call spread that I liked much better. For my simple bull call spread example, if we want to just put down some lunch money, doing something like this, or it could be really explosive. Let's take a look. So I'm going to buy the 950. So I've already showed you a way that you could increase the probability rather than just buying it outright. And now let's look at if we push this same idea really far. So I'm buying one that's really far out of the money. 950 is a little over 10% higher. So that's a huge move for Tesla. And we're basically saying we're going to cap it at 1,000 here. So it's a 50-point range. Now take a look at this profile. So this one, commission's $3. The commission as a percent of the trade is high. So that makes it hard to get in and out of a lot of contracts on something like this. And so if you're trying to move large amounts of money, then we'll look at some other ways of doing that better than this one. But if you just want to spend a little lunch money, I mean, maybe maybe $36 is a lot for some people, and it's nothing for other people. So what this is this is the ask price of 33 cents plus the commission to get $36. So again, because it's options, the ask, you times it by 100, it's $33 plus $3 commission gets you $36. So if you plunk down 36, and by the way, this is going to be, if Tesla doesn't move, it's going to be much less at the end of the day tomorrow. It will be, we can expect it to be $16 less. And so your minimum investment on this could be around $20. And for $20, you have a chance where if Tesla gets to, at the close of Friday, if Tesla gets to 1,000, then this option combo, this vertical spread, will have a profit of $4,967. The probability, however, and this is a stale number. It's going to be worse tomorrow probably. 1/3%. So if you had put this on for $36 at the close, this is telling you that you can expect to take a trade like this 300 times before it's a 1 in 300 chance or less is what this is telling you. And the return to risk is 150 to 1. So you're making 150 times return on your money, but it's 1 in 300 chance. So at face value, this is a losing trade. If we're trying to do the probability math on that. However, this is a nice chart setup, a nice technical here. And there are lots of other ways to play it than the one I'm showing you. But, I can easily afford to put on, at least I can for my situation, I can easily afford to put on something like this for $20 or $30, along with any other way that I might play this. And so it's a way that you could get a little extra juice if you're already going into something like this. I do kind of like this vertical spread. And one reason that the vertical spread works here is because Tesla is such a high share price that the commission as a percentage on the spread is kind of low. And so that's how you can get so much juice. Normally the commission is going to really eat through your profit on a trade like this. So a strategy like this can be compelling on high price stocks, but tactically at certain times. I mean, the market makers aren't just giving money away. You can add this into an existing trade that you might otherwise do. You could just add this combo in. Like if I was going to buy an at the money call anyway, let's look at that. So say I was going to buy an at the money call, and we'll call it the 855. Let me put this right here. Okay. Say I was already going to buy the 855. Well, look what happens when we add this other combo in there. So it's not really going to add anything to this price. It's adding like 36 cents and a little bit of extra commission. But if we look at this same call without that extra juice, the reason why you might want to build this in as one combo is because if you're trying to fill across all these different strikes, the broker can actually find you a better deal than if you're just trying to buy the 950. Because somebody may be trying to make an opposite transaction on one of these other strikes. And so that may actually pay for this ridiculous out-of-the-money call spread all on its own. So instead of having to raise the bid you'd be making on the 950, somebody may be sitting on the other side of the spread already on one of these on a different combo they're trying to do. And then you both get filled, and you may be filling at a lower enough amount you might have had to like pay up the ask. If you look, this bid-ask spread is wider than the total price of that other combo it's purchased at the ask. And so by doing that, there's a fair amount of liquidity at those other strikes. If you notice the open interest at the 855, which is the at the money, or I'm rounding up. I'm trying to avoid this lower open interest contract here. But anyway, if you notice the open interest was even higher on some of those other ones. And so the odds are decent that somebody may be trying to get out or in one of those other legs. And so that's how you can get this extra juice for free. Because if I'll show you the math here. Let me bring up a calculator and I'll show you the math. I already closed my calculator. Oops. And so this is a really, I think it's a clever idea that probably most people aren't doing when they place a trade. Okay, so the bid-ask spread here is 13.58 minus 12.98, 60 cents. And so if you're able to fill at the midpoint, because you put on this whole combo, the midpoint on this is 30 cents. That just about pays for the whole the whole bull call spread. And now I want to show you what this picture looks like without this deep out of the money vertical. So just to recap some numbers here, let's actually flip it to tomorrow. So we're looking at $7,600 for a 10% rise, just under $19,000 for a 20% rise. So let me remove the vertical. Oops, I removed the wrong leg. Sorry. I have to do it like this. Okay. So you can see the numbers here. They're still juicy, but they're lower. And like especially at this top end. So on a 30% rise, 23,000, roughly 24,000 without that vertical. Let's put the vertical back in now. What do we say? 950, 1,000. Okay. So it adds about $4,000 on a big rise, a 30% rise in Tesla. It adds 4,000. So anyway, I mean it's way out there, guys. But if you can get it for free, well, why not, right? And one other tip: when you go to close, if you close this, I mean you can just let this $36 thing expire worthless. Probably if you're splashing in for an 855 call, you probably don't care to try to recoup the $36 if it doesn't work out. All right, so let's move on. I want to look at some other combos. So this is kind of it's a really inexpensive way to dabble if you just want to chip out little bits of money here and there to try these things tactically when the charts line up. Some of these other combos, they cost more money, but they have much higher rates of success. So we're going to look at those. When I say cost more money, I mean more money down. All right. Clear all legs here. So this one is a... Let's see here. We're going to sell a 775. I'm not sure the idea on this one. This may be from the other day. Let's skip over that one. This one's kind of neat. I think the idea here with this one Oh, that's puts. Yeah, no, okay, we do need to look at this one. So sell a 775 call, and we're going to buy two 820 calls. Is this right? This I feel like this is something I was looking at for something else. Yeah, $4,500 margin. I must have been from something else. That's not really what I'm trying to look at right now. So yeah, I think the idea here with this one is I combined the bull call here with also a bear put spread. So let me clear these legs. Let's put on the put one first. So it's a 750 and a 710. So I think what I did is I just put these two together. So yeah, buying roughly a 50-cent one and selling a 25-cent one kind of thing. And then what was the sell on at 710? And again, if you look at the even number strikes tend to have more open interest. Like look at this one. The 750 has way more than the 752 and a half. And so if you're not taking that into consideration, you're going to make your trading a lot more expensive. Okay, so then let's also add in the 950, 1,000 bull call spread. And again, same kind of principle applies because we're going across 4 different legs. It may be that we can get a really great fill if somebody else is trying to move on one of the legs that we are. And so it may be that even though this one looks more expensive, you may be able to get this for like darn near the midpoint. It's possible. And again, let's fast forward to tomorrow. So if you were to put this on near the end of the day, $22 less than 63, around $43. And again, because you got more legs in there, maybe you can get it really close to the midpoint instead of paying at the ask. And so the profile on this one is just the bull call spread, and then on the other side, the bear put spread. And so this gives you two ways. Like if Tesla breaks down instead of like breaking out and running higher, it gives you two ways that you can win. So if you're trying to chip out just a little bit of lunch money and you're not sure whether it's going to break up or break down, this could be a way to do it. And the potential profits on these are, it's if they do hit, they're big. And I mean, I'm not going to talk about the roulette wheel. I was going to, but let's not. All right. So moving on, we've got a few more to cover here on Tesla before we go and take a look at some other, what may be good setups on some stocks. And the reason I'm looking at Tesla right now first is because it's a high price stock. And so there's a lot of different strategies we can use there, even with small amounts of money. So I've shown you the small amounts of money ones. Let's go a little bit bigger. So I want to show you a strangle now. We're going to look at an 805 900 strangle. 805. The idea here was spending about $2 a leg. And what that does is it totals up to about a $400 cost. And so this one doesn't have a margin impact in that they're not going to deduct any extra margin other than the debit that you're paying, which is this. So where this might be good is if you're able to get this at the end of the day, not for $400, but for like $300, and just carry it overnight. And if there's a big gap, it might land you in one of these situations where you've got 10 times your money on a 10% move. And if there's still going to be quite a bit of time left on the options if you get out near the open, and it's a big enough amount of money that it's probably worth it to just punch out if it didn't gap up. Unless Tesla starts breaking out and running at the open, maybe an opening range breakout kind of thing. You're going to have to read it and play it by ear, go by your own read on things. Again, this is all super situational, and we're just preparing. These are just ideas. These are not trade recommendations. These are the kinds of things that I'm busy looking at as the day unfolds. And by building an intuition ahead of time, I can quickly put together the right combo for what I'm trying to do. So this one, if you wanted to put a little more money down and improve your odds of winning, see, this one has like a 12% chance to win. This is a much bigger number than anything that we've looked at so far tonight. And we're going to look at combos that are, if you're even more well capitalized, they can still make fantastic returns, but also have a higher profit probability. So let's keep going. I want to show you the straddle just for comparison purposes. I put an 852.5 straddle in there, but maybe what we probably want to do instead is look at the 855. Yeah, look at that. They're even the same price. So this is a straddle. I'm buying an at the money call and an at the money put. You don't have to do them at the money for it to be a straddle, but that's what we're going to look at. And so right now it looks like, oh, this is great. There's nothing but the entire curve looks like it's above the zero line. Well, what's deceptive about that is there's this big gravity well at the current price that puts a lot of time decay on the trade. So the minimum investment here is a much bigger number in dollar terms than what we've looked at so far. It's now we're looking at something that's more expensive than a single Tesla share. And what happens with the time decay, watch this. Just going forward one day, it's $200 cheaper. And eventually, like at the bottom of this gravity well, if Tesla closes right here at the 855, you lose the full amount, which is the 1325 for the call and the 1340 for the put. You lose that full amount, which would be is showing here. But this one has a profit probability is showing of a 42%. And the break-even levels are 828 and 881. And I want to show you too, let's just skip forward to here. So if Tesla moves up or down 10%, these are big dollar numbers. But compared to what's at risk, the risk to return ratio, I don't know why that's not showing right now. Was it showing earlier? No, I don't know why that's not showing. But I mean, it's a much higher risk to return. I don't like owning these on the last day if I buy a straddle because they're very subject to time decay. I normally don't really put straddles on. I'll use them occasionally, but there's other things I like to do better that are similar. Like I talked yesterday about the Nike swoosh combo, and if you haven't seen yesterday's broadcast, you might want to go take a look at that. I talked about the Nike swoosh one, and that's going to be a recurring theme. I'm going to talk about that one a lot, but not right now because that's for putting on well ahead of expiration and getting out well ahead of expiration generally. And it's also a strategy that's based on actively managing it with rolls, rolling down strikes and rolling outputs and things like that. So we'll talk more about that on a different one. Okay, so that's the straddle, so that you've got the comparison to the strangle. The strangle is much cheaper, and so that's kind of nice. It's got a similar upside too. So. But it has a wider break-even point. That's the difference. The strangle, the stock has to move further at expiration for you to break even. Okay, so the last one that I prepared for Tesla for us to look at tonight is this is a bull combo, I think. These are all calls. We're going to sell an 890. So here's the idea here. See the ATR is 40. So we're kind of using $40 as a little bit of a target. The 890 is not quite 40 points higher. But anyway, I just kind of use that as a starting point. So we're going to, this is a really aggressive way to build this, by the way. Maybe we can go over another way to build it. So we're going to sell an 890. And here's the idea. We're using this $3 to fund a bull call spread, but we're going to do it in such a way that by buying the 900, what this does at this point, if you look at the margin impact, it's $1,000. It's going to cost $1,000 of margin to put this trade on, which is about the amount of a Tesla share. It's slightly more expensive. And so this is useful comparison. The rest of the trade that the rest of the combo we're going to build is going to use this credit. This credit won't be here when we're done building it, or it may be really small. So what we're now going to do is we're going to add an out of the money call spread to it, and we're going to turn it. We're going to turn up the volume by converting it into a ratio also. So we've got about $1 to work with. And so let's look at what bull call spread we can build for 50 cents. And so scroll down here to the 925. And again, I'm trying to stay on these round number strikes. So 925 I bought and then I sold at 955. This is 30 points wide bull call spread, and we're going to get two of them. So this is a commission-heavy trade, and that's going to affect things. Okay. So here's this. And what's nice about this, look at the profit probability. It's 87%. And the main reason why it's 87% is because I pushed this whole thing out of the money. And we'll look at what happens when we move it around across the price, this similar structure. But first, let's explore some of the details about this. So if Tesla doesn't move, here's what's great about it. Watch this. At expiration, and I wouldn't be holding it till expiration. But if Tesla doesn't move, it doesn't lose anything. However, there's this big gravity well right here where it does lose. It loses big. Here's the break-even prices, $890 and $930. And it really loses big between $900 and $925. And if you notice, that's the difference between these. It's the gap between these two strikes that I'm buying. And so if the Tesla price is somewhere in here, you're going to be experiencing a lot of time decay, gravity pulling your trade down. You're just going to watch that thing tick away against you if the price is in this zone. In fact, if it's anywhere near it, it'll be pulling it down. So let's back up and look at it tomorrow. So if you notice this trade, you're putting up 1,000. And so it's more than what we were looking at earlier, but the payoff is basically the same as the other one we were looking at for the original bull call spread. So the commission's $8. It's heavier, and so it's a little tougher to execute this trade. There's a lot of legs to it. What else do I want to say about this? This profit probability is really kind of deceiving because it's treating it like it's a profit because you're getting a tiny little credit if the price closes anywhere in here, and that's why it's showing like, oh yeah, 87%. We don't have an 87% chance of making a big profit up here like this. But if you notice, compared to the original bull call spread we were looking at before, this one closes at a profit at 955. So essentially, by using this trick to rearrange this, we didn't need Tesla to get above 1,000 to make $5,000. We only needed Tesla to get above 955 to make $5,000. The difference on this one is this is collateral, And that collateral comes into play when Tesla is in the range around 890 and 930. So there's a little bit of danger there. If you want to, what you can do is you can put this point right here, the 900. You can put that at the money, so that what happens is this sort of launch off point right here is really close to where Tesla is currently. And so, like in this case, it has to like really start moving up before this trade even comes alive. The way I've structured it now. But if we pull these strikes down to at the money, so what am I gonna subtract here on this? Let's take the 890 and let's go to 855. It's not gonna let me do it nicely like that. Okay, well, let's just rebuild it. Sorry. All right, we're gonna buy the 855. And then we're going to sell the 865 so that the margin impact, I did that backwards. Selling this one, selling the 855, buying the 865. Margin impact is 1,000 again. And we've still got some price to work with here. It looks like about $4, so we can build a $2 bull call spread. Let's see where we can build. How about this? And we're going to get 2 of them. So as you can see, by pulling it closer to the current price, we're posting 1,000. The max potential profit's only 2,000. So I like this one a lot less. Okay, so that's what I have prepared for Tesla. Next thing I want to look at is ACB. The reason I want to look at ACB is because this chart looks like it is breaking out right now. So somebody pointed this out on Twitter. I'll try and retweet it tonight. And sorry, I'm blanking on who it was that tweeted it out. I'll retweet it tonight. And so people can follow that person who pointed out this awesome chart pattern. So this is Aurora Cannabis. And now I flipped to the daily chart. And I mean, this is a really beautiful setup. It looks like it's breaking out right now. So this may start, and you can see how explosive this thing can get. So if it gaps up, you may be looking at a situation tomorrow. You may be looking at a situation right here, where over the next 2 days it goes from up 100%. This thing has done it before. Doesn't mean it's going to do it again, but I mean, this is an explosive setup, so it's certainly possible. So I may be looking at this one all day long and maybe getting in early if I make a move on this one. I may not be patient, and so one way you can do that is kind of average in. Or don't buy it all up front. So let's look at ACB. Got that here. I didn't put together any combo or prepare any combos already on this one. Thought we just kind of play with it in the option combo builder and see if we can find anything interesting. So that's what these trading homework broadcasts are about. They're about brainstorming and preparing. So let me get these Tesla numbers out of here. We don't need those anymore. Okay, so at the money is $14. Let's just look at a straddle. I don't think I would buy a straddle. Yeah, I don't think that really looks interesting. And if you notice, the bull call spreads look really expensive to build on this one. So let's do what we did before and note our levels. I'm going to start here with the ATR. ATR is only $1. I don't know that the ATR is going to matter a whole lot on this one. So what we could do is we could look at a weekly ATR and buy something that's out of the money by that amount. Weekly ATR is $2.50. So let's take a look at 14 is at the money, 250 higher. There isn't one. We go a little further out of 17. Now let's look at the 16. So this is $21 plus commission. Let's talk about these numbers. So looks like let's fast forward to tomorrow. If ACB is not moving tomorrow and we put this on near the close, we can expect it to be a little cheaper, but not necessarily a whole lot. And so this kind of goes back to where I was thinking that it may be better to move early on it. And this is also an example where if you look, this is, you put $16, or I'm sorry, is that, no, I misspoke, $23. Well, instead of buying two of these at $23, if you bought two, you'd be looking at $370 gain at a 30% rise. But instead, what if we just bought one that was twice as expensive? Let's take a look at that just to keep it as a baseline. That would be here. That would be at the money. We bought one. It makes slightly less, but the commission as a percentage of the trade going on, it's much smaller. So things get tricky when you get into these really cheap stocks. Next day expiration, I mean, like this is maybe not even worth doing anything with, but let's see if we can come up with anything interesting. What about this? What about selling an at the money thing, doing a back spread on it? So we're selling a $12. Do we want to sell a $12 thing? Now let's sell $13. So one daily ATR lower, 88 cents. Now we have 88 cents and we can buy 4 16s. Does that look interesting? Profile. Maybe if we got in at the open and we got out by the close. So in other words, like once you get into Friday, this whole this whole triangle below the zero line and under the dotted line comes into play. It looks like this would be a safe one to do if you could get in and out of it easily tomorrow. So if the options are really liquid on it, and let's take a look. Do we have an indication here? Yeah, 100,000 average daily volume on the options, 100,000. So that's interesting. A fair bit of open interest on some of these strikes. The 13 would be a good one to sell because it's got so much open interest there that if you had to buy it back, you'd probably find that it's a pretty tight market, and probably pretty liquid. So, what would we be putting up? A collateral of $300, and we can make $300. That's. I mean, that might be interesting if you thought it was going to move 100%. You know, now you're talking 10 times your money. I don't know that it's going to do that. For me, I think maybe this ACB probably is a lot more compelling as a longer hold. Because if you put on options with a longer duration, like let's look at the Nike swoosh on this real quick, because I haven't looked at this yet. So the idea here is we're going to buy something 3 to 6 months out at the money, because there's very little time decay on that. Watch this. Let me go into the performance profile and watch the current here when I look at, I don't know, a couple weeks out. Doesn't really lose money if the stock price stays still. but I don't just want to buy this call. So now we're talking, because we've got a commission as a percentage of the trade that's really low. However, the risk on this is really high. And so what I'm going to show you is something that is you may be familiar with a synthetic stock position, which is where you buy the call and you sell the put. Here's what that looks like. It looks like this. It moves up and down as if it's the stock. Only instead of paying $14 for this thing, in this case I'm posting $700 of margin. So this is like buying the stock on margin, right? But what you can do is put a shorter duration on it, and then the margin is lower, I think. Let's take a look. I think that's typically how it works. And then we're going to come back to and finish out the swoosh idea. But here, let's look at this. Oops. We're buying a call and selling a put. That's synthetic stock. And on this case, I only had to post a margin of $487. So I'm getting a better deal than if I bought the stock on margin. It's just taking me less margin to do it. The downside is if they declare a dividend, I may get early exercised on. In fact, the odds are pretty high you'll get exercised on if you try and hold a synthetic stock. And what that does is it puts you at into the stock and on margin. So maybe you saved on margin temporarily. So what I'm going to show with the swoosh is something that doesn't have one of the downsides of a synthetic stock. The swoosh combo does not have any early exercise risk. So let's go take a look at that. The way that it works is we're going to buy an at-the-money call with a 3 to 6 month duration, and generally I favor the longer side of that. And then 3 weeks out, roughly 3 weeks out, this is I'm going to say 3+ ish weeks. I like to keep these rolling 3 weeks out, the puts. We're going to buy a put that's like 10% lower. And you want it to not be a huge percentage. So let me clear that back off of there, and I'll show you what I'm eyeballing. So if I just have the 14 call, here, let me clear all these off. I skipped over something important that I want to show you. $4.10, and that will appear right here in the IB window. If I'm looking right here, if the market's active, it'll appear right there. So anyway, it's $4. I wish they would have an extra column right here. There are columns that would tell you like the bid and the ask on it. So this is about a third. The put I'm buying with a lot less duration is about 20 to 35% of the price of the call. And it's got a very much shorter duration, and I'm typically rolling it to keep it from getting close to expiration. That costs money. So now let's look at the profile for this. See, looks like a Nike swoosh. So this is a swoosh combo. If we look at it next Monday, you'll see that it's got some time decay, but it's got really nice upside. This is, if I think that the stock to move 100% or more, like, say Aurora Cannabis in the next six months makes its way back up to, I don't know, $50 or $123, and I can roll the call out too. By the way, if I want more time, I can roll the call out and give it more time if I thought it was going to make a move like what this got reversed. So, I mean, if we're looking at Aurora between 80 and 120, I mean, it's this could be really profitable. And what happens, I explained this yesterday, so I'm not going to go into too great of a detail, but if the share price drops, what can happen is, if the share price crashes down, the put starts to take over the value. And what this can let you do is start over, either get out of break even or just roll the trade down on strikes. and out on the put. You can essentially reset it for free, and so I'm always watching to roll these things down if the opportunity comes. If they crash down a bunch. So that's the swoosh. Let's get back to our main topic though. ACB, I don't know that that's really a good next day expiration candidate. I do like the chart though. The other one I had for next day expiration that I wanted to look at was QS. So this is QuantumScape. And we're looking at a weekly chart right now. It had a huge move recently. Let's look at the daily. And it looks like the slide, it may be over. We're seeing volume come in. The price is starting to turn up. And so this could be explosive to the upside. So let's see if there's any QuantumScape next day expiration opportunities. So I'm on the right calendar, 2 days to go. It's right now it's $48 at the money. This could be 50 by tomorrow, or it could be 60. So you can see these options get real cheap, and if it doesn't gap up, these are going to keep getting a lot cheaper. And so it doesn't look like I can do a whole lot necessarily with vertical spreads, but in a situation that's so explosive like that, it may be that doing something like buying a look at the open interest here on the 50. Let's take a look and see what it would look like buying a 50 call. 100% is ridiculous. Let's not even look at that. So profit probability is showing 22%, and it can't calculate the return to risk because it's these infinity signs right there. But it is, yeah, it's telling you there's like no chance of an infinity profit. So this is a situation where I think a 30% move could happen. It might get a lot cheaper tomorrow. So what can happen here is if we get close to the close tomorrow and this stock hasn't really moved anywhere, this same call that could be worth a ton of money at expiration. If QuantumScape gets to $50, it could be worth $900. If it gets to 60, the call could be worth like $900. And we might be able to get it at a big discount. That doesn't really look right that it would be higher at the current price tomorrow. I don't know why it's looking like that. If the stock doesn't go anywhere, this should probably be trading for less. So if I can get this cheap enough, awesome. And then I'll give you another tip that I use is if the stock does run up here a whole bunch, and the call's worth 60, what I may do, if the share price is around 60, something like that. If it looks like the move is running out of gas, I'll show you something else that you can do. So say we had the, which one were we looking at? The 50? Yeah. So say we bought the 50. If the share price gets to 60, well, it may be that something like the 65, like if we don't think that the price will hit that, what you could do is I showed that it would be worth 900. The 50 call would be worth 900 at $60 share price. But let's see what the 65 would be worth, because what you can do is instead of selling the one you have, you can sell one at a higher strike and essentially turn it into a bull call spread. And that way you can make a little more, but essentially lock in a lot of your profit. So by looking at this one, let's see what this one would be at $60 share price. So this one would be $184. So what you do, if it looks like the stock's topping out, if you didn't want to sell the option you had, you could sell one at a higher strike. So it's something to keep in mind. If you do that, just be aware that if you don't put it in the same calendar, then weird, screwy things can happen. And that has to do with changes in implied volatility and all kinds of things like that. And so it may be that selling a 65 isn't the right thing to do. Since you're so close to expiration, probably the best thing to do is punch out. But if you thought that the stock was going to base for 3 weeks and you had a call that had run up a whole bunch, you can sell one. It's sort of like how you might sell a covered call with stock against it. Is if it gets called away from you, then that's fine. Selling a call in the same calendar will cap your profits at that price. And so if the stock you think the stock may be topping out and moving into a base. In the example where we were looking at the Nike swoosh earlier, you can sell one that looks like a ridiculous price to you and maybe kind of like slow down the losses instead of getting rid of your position. All right, well, we've talked about a lot. That's really what I wanted to cover for tonight. Thanks to everyone for tuning in. I'm going to end the stream here. Good night.